We are focusing now on our shift towards development, and we're going to start with taking a look at the simple question of how development is measured. Now, we're going to be engaging in a much more thorough analysis of this in class, looking at some of the major indicators of development. We want to give a broad strokes idea of what it is what information people use to determine whether or not a country is truly developed. This is a review definition, but you can take it down as needed. That development is simply the process of improving the material conditions of people through the diffusion of technology and knowledge, and is represented in continued progress. So the idea of development is that you're going to continue to move forward, like the demographic transition model. According to that model, there's no going back, which could happen theoretically. And when we discuss development, the idea is that countries are consistently developing, and we'll see whether or not that's actually the case as we go forward. Three major categories for now. We'll introduce new terminology momentarily, but for now, we're going to use the ideas of most developed, developing, or and least developed countries of the world. Do not need to copy this all down, but this is just the general idea of some of the social, economic, and demographic, meaning population, of course, indicators of development. So these are all the things that we have covered largely already throughout class, the entirety of this year. So for terminology you're familiar with: life expectancy, literacy rate, infant mortality rate, total fertility rate. These are some of the key indicators that people use and geographers use to differentiate between the lesser developed countries of the world and the more developed countries of the world. Very logically speaking, let's take infant mortality rate. That'd be quite high if you're on the left in the less developed countries of the world, whereas if we go to the right, to the most developed countries of the world, you're going to have a low infant mortality rate. So these are the general characteristics that we've looked at so far, and we're going to continue looking so momentarily. Okay, so pick it back up here with the Human Development Index. So this again is the scale from 0 to 1. It's used by the UN to measure a country's level of development using 4 characteristics: life expectancy, literacy rate, average years of education, and gross domestic product. So it's the sum total of the amount of products produced within the country divided by the number of people. That's the per capita piece. This, of course, this is a really generic way to look at the development of a country, but it's certainly not, and it does give us some indicators of some patterns and some trends, but it's not sufficient. It's not enough to explain A, why, or B, the reasoning behind that. So we're going to kind of dive a little more deeply into why it is that these, what are other indicators of development, as well as a specific theory called world systems theory about how these countries, about what the factors that drive these economic differences. So 3 terms we need to break down. Economically speaking, there are 3 economic, that's redundant. There are 3 economic measures of development. The first is called gross national product, GNP. I'm going to read the definition and we'll break it down. The measure of the total value of the officially recorded goods and services produced by the citizens and the corporations of a country in a given year. So, in other words, how much money people are making from their goods and the services that they offer in a given year. This includes things that are produced both inside and outside a country's territory. Let's think about a connection to agriculture. In this instance, for GNP, we're speaking about the profits made by an American company, such as, say, Syngenta, who has an agribusiness that has worldwide global presence. So the GNP would include the revenue not only made within the United States, so let's say if their headquarters, actually don't know where their headquarters, but let's say if it's in Research Triangle Park in North Carolina, then let's say that they would include the revenue from that headquarters as well as any of the income earned abroad. So GNP is a little bit more of a holistic sense of the economic forces of a country. In contrast, the GDP, which is a commonly used one but less inclusive, is the measure of the total value of officially recorded goods and services produced by the citizens and corporations of a country in a given year, inside that country, hence that word domestic. In a globalized world, we now know this is sort of an insufficient analysis because there are plenty of transnational corporations who have presence globally and who influence all kinds of different dynamics. Lastly, we have gross national income. This is less commonly used in some of the AP Human Geography material, but still a good one to know. Because as it says there, it's one of the most common measurements used today. It's the measure of the monetary worth of what's produced within a country plus income received from investments outside of the country. So this here is now going to include, this is another more holistic idea of what the investments, the money that people make from outside investments, external investments. Do you own an international stock fund? That though you yourself are making money off of international markets. I'm actually going to really have us focus right now on the GNP versus the GDP. There are other measures, of course, just not just about money. There's other ways to see other factors that, of course, are economically rooted, but other factors to measure development. One of which is the consumption per energy per person. How much energy use is each person? How much energy is each person consuming? In the United States, we are embarrassingly high. You can see there that with the amount of energy, we supersede every other country of the world, and that's an indication. Yes, we are one of the third most populous country of the world, but that certainly does not as a sufficient justification for the enormous amount of energy we use in our country. Generally speaking, the greater use of electricity, the higher the development of the country. So the more energy we use, the more resources we depend upon from a nuclear energy standpoint, from coal, everything else. This is going to be a reflection of the development of the country. Another indicator is productivity per worker. It's the production of all goods divided by the total labor force. You consider this makes sense if you consider agriculture. Is the total production going to match at a 1-to-1 ratio of the number of people in the country? If so, that's a subsistence economy. If you're producing an enormous amount of goods divided by the total population, and the production far exceeds the number of people, then clearly you're mass producing material, you have a surplus that can be sold, and then in turn you have a more developed economy. One of the problems, the problems associated with those two, with the measures of the I'm sorry, this is a little out of order. This slide should have come before this. The problems with the GDP and the GNP. Neither of those measures recognize regional variation. So, for example, you could have a very rich region of a country and very poor what's called the hinterland, a term we'll talk a lot more about in urban geography. Hinterland is the outskirts of the city, or the outskirts area, period. So, for example, within a country itself, you can have areas that are extremely economically wealthy, and you'll have areas that are extremely poor. And neither the GDP nor the GNP is going to recognize that. So it can give a false impression about the total development of a country when, in fact, only part of that country or a region of that country may, in fact, be developed, or vice versa. Maybe there's a large majority of people who are quite poor, or, just vice versa. It doesn't reflect the regional distribution of goods. So that's a problem with the GDP and the GNP. Another measure of development is called the occupational structure of development. We already talked about this, and this is pretty basic and straightforward. That this is the percentage of the workers in each sector of the economy. Of course, an LDC is going to be primarily, the majority of the people will work in the primary sector. Secondly, there'll be some people in the secondary sector, and there'll be very few people in the tertiary sector. So look at those two lines there. You can see the red is the indication in an LDC, the dotted red line. You'd see that the vast majority of the people in LDCs work in the primary sector. That's gone down, and we can contribute some of that to changes in agricultural practices. But on the whole, from 1820 and 2000, the vast majority of people in LDCs work in the primary sector. In contrast, look at the solid red line. You can see from 1820 to 2000, that is an enormous drop in the percentage of people in MDCs who work in the primary sector. So just logical distribution of economic activity. Another way to measure development is to take a look at the transportation and communications available per person. So, in other words, what access do people have to these transportation and communication systems? How many railroad lines are there as related to the population? How many miles of road are there? Is the airline flight global patterns, are they connected with other places? In fact, if you take a look at this map right here, it's blurry, and I apologize for that, but I actually love these maps. You can see cool maps of flight patterns at night if you Google that. And this is just the flight patterns around the world. I mean, you can see like Western Europe is extremely right, as is the Northeast, the Boswash corridor. You can see down in southern Brazil, you can see some of the developing region there. You can see East Asia and the rising. I mean, even Japan is an island nation, and you can still distinguish it here on this map because it really, really strong indication of the globalized areas of the world and the most developed countries of the world. A reflection, again, of access to transportation and communication systems. You could talk about the percentage of telephones per person, radios, internet access, computers. All of these are indications of the extent to which this country participates in a global economy and the extent to which they are a developed nation. You can see down there in that bottom right, we'll come back to this when we talk about favelas in Rio, but you can see the concentration of electricity lines. I mean, clear indication, that is a massive fire waiting to happen. But you can see signs of growth and signs of development as more and more people gain access to electricity. You could also look at the consumption of manufactured metal per person. So the more steel, iron, copper, and aluminum that's being used in a given place, it's also an indication of development. Subsistence farmers have little use for steel, but a commercial farming industry complex wood, a very highly industrialized place is going to have a higher consumption of manufactured metal. But why aren't these measures enough? Why can't we just say, look at life expectancy, look at GDP, look at the occupational structure? Why can't we just take a scientific analysis of a place and say, here's the data, therefore this is what this country is? Well, one, we already talked about, it doesn't account for regional variations. But two, these measures only count what's called the formal economy, which is the legal economy that the government actually taxes and monitors. You and I live in a place, in Washington, D.C. here, consider the legal economy being any of the retail that you would see in Georgetown. Any retail you see, period, is going to be legal economy. If it's a business that is registered with the government, they have a storefront, they are what called a brick and mortar store, they have an actual place that they exist, then they're part of the formal economy. Of course, the other back alleys, other stores that serve as fronts for other things, of course there are. That's the way of this world. But the formal economy, generally speaking, as you see, that's the known economy. That's the businesses that the government tracks. Then they tax. More importantly, the informal market there you see in Ecuador. That's not the business is not the government is not necessarily sitting there regulating exactly how many of those plantains are being sold in that market. Looking in Brazil, you see the brick and mortar store there on the right hand side. The gentleman who's selling jewelry on the beach, that's not part of the formal economy. That's not necessarily being tracked and taxed. Consequently, this informal economy that's either illegal or simply uncounted. We don't mean to imply that anyone that's making a living for themselves is doing something illegal. Sometimes governments just simply don't have the infrastructure available to track these kinds of businesses. So if it's illegal or uncounted money that the government doesn't tax or track, then there can be an enormous part of the economy that's just not accounted for in these measures at all. That they're just not it's not known, essentially. So there it is. Those are the basis of development, some of our indicators of development. Go ahead and pause on your analysis here. And that's it.